Well, if how's everybody feeling about the market? If we could spend 3 or 4 minutes, I'd love to hear how everybody's weekend was, what you're seeing. Lots of multiple offers, not very many, half and half. What are you guys seeing?
I'm not seeing many buyers.
Okay. Many new buyers
Uh,
or
Not a lot of buyers coming through my listings, but I feel
okay.
like the ones that are definitely ready, willing, and able.
Okay. So the ones that are out there are making things happen, the ones but not many new is what I just heard. Kendra, you sold your last 3 listings with multiple offers. Where have they been and when was that?
Yeah, we hit on this last time we met too. One was in Strongsville, but still it was 7 offers. One
How
was
long ago?
2 weekends,
Okay.
and then the other one was in Whitehall. That went 2 offers in 2 days, 6, 7,000 over asking. And then our
When?
same time 2, 3 weekends ago.
Okay.
And then my Highland Lakes one in Westerville had like 70 showings and 6 offers, probably 5 weeks ago.
Okay. What about anybody have listings last weekend or the week like yesterday or the weekend before that? And what was activity like? Equal, greater, or less than expected?
Less.
Rachel, you're doing a lot of nodding. What's that mean?
I am just learning from the other agents and just okay, noted,
Okay, sweet. All
noted.
right, awesome. Well, Rachel's approving of all of your
Oh,
information, so
I am excited for a listing. I have buyers right now only.
cool. How are they doing in terms of have are they still looking pretty hard or the same as before, or have they slowed down at all?
Yeah, I think I was um just trying to polish up a system that isn't so like, yeah, sure, I'll show you everything you want, but still being like, let's narrow it down to, a couple properties. And then that really helped. And then like it was mentioned, the ones who are ready are really ready. And I'm just trying to find that balance of identifying it a little bit sooner.
Okay, cool. Tracy, you unmuted. Did you
I
have something to add?
did. I've just seen that in the last literally like 2 weeks that it's gotten more, seems to be a little bit more busy and a little bit more commotion out there. Now we had the little price drop, not price drop, interest rate drop. And like for a couple of days, I think people maybe got excited. Then I kind of feel like they backed off thinking, well, I'm going to wait for it to drop more or something. I don't know. I'm hearing, do you think this is a weird market from handymen, from loan officers, from other agents, from like the whole, everybody involved is like, isn't this weird? Two houses beside of each other, the same, everything identical, including price. One will go in a day, and the next one will sit for 3 or 4 months. So I don't
Yeah.
know. It's kind of weird. I did have a listing that had a little bit of attention. This was the week before last, um, and then it had a little of attention, and then they were trying to lowball it, and no. So then it lulled for a couple of days with no showings. And I'm like, okay, what's going on? Next thing you know, there's a whole bunch of showings again, and they want to hurry up and get under contract before we have an open house, because they don't want anybody else to buy it. So
Yeah.
it's like I don't know. It's
Yeah,
just
it's
kind of
pretty
unpredictable right now.
bipolar. It's a bipolar market. So,
Yeah,
okay,
there you
cool.
go. That's it.
Well, I definitely think that we're at least on my team, we're seeing the same thing. I mean, this is as we'll get into, this is historically, the busiest month of the year when it comes to buyer activity. And so for all of this chaos to be happening during that month is definitely a thing. Give me actually 1 second. I'm sorry to do this, but give me like 20 seconds. Sorry, guys. I needed one slide updated and I forgot to talk to Allison about it earlier, so I'll have that for you. But I'm going to go ahead and jump in. I definitely think this time of year, it kind of is reminiscent of hopefully it's not like 2022, but in 2022 where we had like a really good start to the year and then things got crazy right around the time where usually things are busy. It's just it makes for an up and down almost by the day, sometimes by the hour feeling. So I'm going to go ahead and share my screen here and get started with the PowerPoint. I would love it if you guys participate. So definitely don't hesitate to interrupt me, to unmute. If somebody puts something in the chat and I don't see it, please feel free. I know you know who you are, the people that don't mind interrupting me. If you see something really good, please unmute and interrupt me because it is sometimes difficult for me to check on everything and I get off on a tangent with stuff. So really quick from the chat, it looks like Karen Dallas has buyers, not current listings. She's had listing agents call her to follow up after showing, see if her buyers are interested. That's different than the past few years. And then Kendra said she had a buyer that rescinded an offer. Kendra, would you say that that was because of getting cold feet, or was it just a weird one-off situation?
It was actually two different sales, both over $1 million too. The one was a 43-year-old male with a family, and he was getting money from overseas, and his parents said, you do not get the family assets because of the tariffs.
Okay.
And that was shocking. So he had to pull the offer because we had no money. And then I have the seller on another one, and we accepted a June closing. And the buyers said that we were going to move up to April, and they actually pulled that away because of the tariffs and everything. They just got cold feet. So we're still closing on that one. But they were afraid to close sooner. They wanted to wait and see how things shook out.
Which is, I'm sure your seller's super excited about keeping your fingers crossed.
It was actually awful because the agent and I have a really great relationship, and it's my fault. I didn't have anything in writing and I shouldn't have told my sellers, but trying to get them excited because I was excited closing 2 months early. It was not good.
Yeah, for sure. Sorry, I quit sharing because I thought Allison sent that over and I don't see it. Oh, she sent it to me in chat. Sorry, it's the showing slide, which in my opinion is one of the most important things that we go over. And so I just want to make sure that I have that updated one for you. Yeah, that is interesting. So I do have some information in here about the tariffs. Just basic stuff. If you've been kind of wondering, like, what the heck does all this stuff mean? I don't even know, like, what a tariff is. You're not alone. But certainly, I think that's why I was asking about timing, because I do think it has an impact, or has had an impact on consumer confidence, which leads right into those types of like kind of bipolar decision making and just not being sure. Uncertainty is the biggest killer of action historically, and this is going to be no different. So, all right, hopefully you're in the right place for April Columbus market update. I will go over national stats as well. So if you're new to the setup, I typically go over national stuff first. If you're not from Columbus and don't care about Columbus, you can jump off. I'll let you know. But I have a bunch of stuff about the Central Ohio Columbus market that we'll also go over. I run a team here at KW Consultants. I'm also an investor. I own over 20 properties and have a property management company. I do a little bit of coaching. That's certainly not my main what I do all day, every day. But feel free to follow me on social media. All right, market trends. So today we're going to go over interest rates. And unfortunately, that's somewhat of a lie. I was holding out hope until the last minute, so I have a couple blank slides. For some reason, Mortgage News Daily, their website is messed up. And so I can't get the historical data that I usually do. But I do know rates are down a little bit today. They sent me a message. The 30-year fixed is at 6.98% on average, with the 15 at 6.45. And so I'll go over that in a second. So a little quick education on tariffs. What are they? And then we'll go through those inventory and selling trends nationally and then locally. And like I said, for those of you that jumped on late, please feel free to interrupt me if you have questions or comments or can add to it, because certainly I think those are the most productive sessions that we have are when you guys participate. So one thing I always like to say is just, you know, the whole purpose of this is to help you guys become what Gary Keller says is the local economist of choice. Essentially, I got into the business in 2004. I started to get busy right before 2008 when the bottom fell out. And I think my brain just works as a numbers person. And so it was easier probably than for some of you guys. But learning, lending, and understanding mortgages, I feel like was a really big key for me to survive the downturn in 2008. And I think when you're in a slowing market, it really is about how do I survive and less, you know, and then as long as you survive and you build great system and habits during those times, when the market does shift back to something that's quote unquote easier, it's pretty easy to thrive. I should say it's simple, not easy. It's never easy to be like very successful in this business. And yet when things are really difficult and you make it through it, when things aren't so difficult, it feels way easier than it probably should, just because you can always go back to, well, at least I didn't have to talk to anybody about bringing 50 grand to the closing table to sell their house today, right? You can always go back to those terrible conversations and be like, yeah, it sucks that this request to remedy is bad, but at least I didn't have to tell somebody to write me a $50,000 check to sell their house. So yeah, so I encourage you guys to pick one or two things out of this presentation and know it like the back of your hand, and be able to just show your clients that you know what you're talking about when it comes to the market. You should not, nor do I think that you need to know everything that I'm going to tell you today by heart and be able to regurgitate this. Most clients and some of you probably don't care about everything that I'm going to talk to, and you don't want to create objections that weren't ever there. However, if a client brings some of this stuff up, it's really powerful if you're able to talk them through what it might mean to them when it comes to buying a home. So this is where we're supposed to see a nice chart about interest rates. However, since Mortgage News Daily's site is down, like I said, the average rate today as of an hour ago was 6.98%. Typically here locally, we see rates anywhere from 1/4 to 0.5% lower than the national average. This is for top tier borrowers. So without going into the weeds on this, people that have high credit scores and fall within the debt to income ratio at like limits of getting the best interest rate. So Interest rates overall, it would have been very valuable to have this today because somebody mentioned rates went down. They did go down 10 days ago. And then last week they shot back up to the highest levels of the year. They came down 0.1% today. So that's a trend in the right direction. However, the markets as a whole have been just total chaos over the last 2.5 weeks. It'll be 3 weeks on Wednesday, I think, since the tariffs were announced. And it has been a wild ride, to say the least. And I think that we're maybe moving in a direction of some certainty, but I don't think it's going to be quick. And I would expect volatile rate environment for the next several months, as well as, if you care about the stock market, volatile stock market environment as well. They kind of go hand in hand. All right. So really quickly, which is not a quick conversation and everybody has an opinion, and I haven't heard two people give the same one, but this is what Google says a tariff is. It's a tax imposed by a government on imports. So for example, if there's a factory in China that makes a toy and they put it on a boat and send it over here, when the receiving company, so some company paid $5 for that toy in China, they sent the $5 to China before the person is allowed to come pick it up from the port. The government says, in this case with China, it's actually, I think, like 145% tariff. So they have to give, they paid $5 to China, to the Chinese company. They now have to give the government $7.45 more in order to actually collect that good. Obviously, that happens on a big scale. That money goes to the government as revenue. So just like for all of us that are, I'm sure, over the moon excited about what day tomorrow is, but for those of you that have had the pleasure of writing your checks early, or those of you that are going to wait till tomorrow, the same way that you write that check to the government, the company that is bringing in that product from a country that has tariffs will pay that to the government as basically a tax. Now, there's two types. It can either be a percentage of the imported good, which is what we've been talking about, or it can also be a fixed amount per unit. So for example, instead of saying it's going to be 145%, somebody could say, the government could say, well, on every toy that gets brought in from China, you owe the government $1. That would be a specific tariff. And then there's also tariffs, and this is where it like gets into the weeds, but there are also tariffs where they say like, well, you can import 100 toys with no tariff, but once you start on the 101st toy, that's when you have to start paying a tariff, or maybe that's when you have to start paying a different tariff. And countries across the world do this to each other in many different ways. And I'm not going to go into all the details of like the non-tariff trade barriers, which there are many. But ultimately, they use this as a way to try to get countries will either put tariffs in place in order to limit the amount of imports, in order to encourage people to build stuff in their country, which creates jobs in their country, or people will also put tariffs in place if they want to protect an industry, meaning if maybe if you're China, you make all the toys there. And so since you make them, you don't want other people sending their toys because you want your citizens to buy the toys that you make. So you make it really expensive for other companies to send their toys, and therefore they don't import them. And then you get to sell more of your own toys that you make in your own country, which is what we're trying to do if you follow in detail with cars, for example. So now the big drama around the tariffs is who pays it. So initially, the company that's importing it pays it. But what often, like for example, Walmart, they reached out to their distributors in China and said, hey, we used to pay you $5 for that toy, but now we have to pay $7.50 for the tariff. And so you have to lower the price by $4 or we're not buying those toys from you anymore. So obviously the company's still paying some. And this is an extreme example because China's the only one that has over 100% tariffs. But I hope that that kind of makes sense. Does that all make sense? Or are you guys more confused than you were when you got here? Good. All right. Either you're all confused or you're ready for me to shut up about tariffs. But that's basically what tariffs are and how everything's going to shake out and what this is going to look like a month from now. If you know you can be really rich and should get off this call right now and just like go invest in the things that are going to benefit from that. But I don't think anybody really knows. I'm not convinced that our government knows. All right. So economic data. The crazy thing is that last week interest rates shot up. And if you would have taken the tariffs away, interest rates would have done very different things last week. But the tariffs have created a decreased consumer sentiment. And then it's also created headlines around inflation. That we are going to see more inflation as a result of tariffs. There are many people who are saying that it's going to cause inflation. There are also many other people that are saying that it's not going to cause inflation. I don't know enough to answer that question for you, but just know that based on these numbers here, the general public believes that it's going to cause inflation. So whoever's messaging the higher inflation, they're winning the battle around consumer mindset. And so 6.7% is what the average person that was surveyed believes that that's the amount of inflation that's going to go up. It was previously 5%. And then the number that people believe inflation is going to happen over the next 5 years is 4.4% inflation versus what was 4.1%. I feel like these numbers are very emotional because the average person can't tell you why they feel that way, but they do. And so this is the reality of what the consumer is thinking. And so the consumer believes that there's going to be higher inflation, and that's why their consumer sentiment or consumer confidence has gone down. So only 50%, 50.8% of people feel like the economy is headed in the right direction. Now, the reason why in a normal week, minus tariffs, we would have been in a really good position is because for 3 years, 4 years, we've been talking all about inflation. And in the month of March, we were forecasting that core producer inflation, which is like wholesale prices, was going to go up by 0.3%, and it actually was down by 0.1%. So this is all pre-tariff. And then we also thought that the year over year wholesale prices were going to be 3.6% higher, and they were actually only 3.3% higher. So those were all two. And then the day before that, which isn't on this chart, the consumer price index, meaning what we actually pay as consumers, was also better than expected, lower than expected. So the numbers were really good. The problem is no one believes that those are going to go forward now with the tariffs in place. And so all of the goodness from these numbers was ignored. And everybody was solely focused on what the tariffs were going to do. And then this is just your consumer sentiment in a graph form. So you can see that during kind of the election, things were starting to tick up. Definitely into December, things were at the peak in terms of consumer confidence. But post election, things have gone way down. And a lot of that has to do with tariff conversation, honestly. And the fact that people are nervous inflation is coming back. All right. that was your economics lesson for what most of you hope is probably the rest of your life, but at least for this month. So here we are into the real estate stuff. So active listings are up, as you guys know, it's true locally as well, but it's 28.5% nationally. The total number of listings, so includes active and in contract, is up 17%. So that tells us that contracts are down. We did not have pending sales for some reason. Realtor.com every once in a while, which is where we get the national data, just leaves things out. I haven't figured it out, but it is what it is. Days on market was up slightly on the national basis, but you can see all of this stuff up here is pre-pandemic. We still are kind of trending the longest post-pandemic year that things have sat on the market, but nationally we have still not reached yet any of that like 2017 to 2020 days on market amount. Median list price nationally has loved this area, right? Like every year for the last 3 years, we've been on the same trajectory. As you'll see locally, we've definitely seen prices continue to go up. But on a national basis, some areas like Florida and Texas have been hit the hardest. The West, where I spend a lot of my time in Colorado, they've seen some hits on pricing as well. So in general, the areas that saw the most appreciation during the pandemic period have started to soften a little bit on pricing. Places like the Midwest and Northeast, which saw still a lot of appreciation, but less than the West and the South, they've stayed relatively or a little bit more solid on the appreciation front. Number of properties that had a price reduction has continued to be well above recent recorded history. I think a lot of that has to do with the fact that the average seller still has their mindset in a multiple offer mindset. And I think we have a lot of agents that still either don't have the experience to have the tough conversation about pricing, or just feel confident that the listing is going to sell, and so they just go with the seller's opinion, and then it's requiring more price reductions. Whereas in a market where the average house sits on the market for 3 or 4 months, the average listing agent is having a much more aggressive pricing conversation up front. And I believe that that's what's leading to this higher level. I'm not sure this is a great indication of market activity one way or the other. Big swings in this number do, like in 2022 when interest rates were going up. You can see how the percentage of properties, this is a leading indicator that we probably have some softness in the market. But like a little bit here and there, it's kind of on par with where it was last year. Because what is it, the gray line or the brown line was last year, and it's kind of online, on a similar trend to years past. All right, regional stats. They used to have a bunch of other cool stuff. I might even start taking this out, but it's kind of interesting still. Median list price year over year is down. Again, this is list price, and I have some more detailed information on this about Columbus, but the median list price is down year over year. This is not median sales price. Northeast is still holding out as the only one that's positive. And then West is even, which they've been getting probably hardest hit, maybe next to the South. The South is still a little negative. In general, though, within 1 to 2% of zero, kind of negligible. So long story short, new listings are still up a little bit, but active listing count is up quite a bit. But again, we're not seeing, even nationally, as we saw with that median list price back on we're not seeing a ton of negative pricing pressure, meaning we're still seeing the average market holding on to most of those gains that happened during the pandemic. So, all right. Anybody who doesn't care about Central Ohio, this is your off ramp. Does anybody have any questions at all about national stats, the econ lesson, tariffs, anything like that before I jump into what's happening in Central Ohio? Speak now or forever hold your peace. All right, cool. Well, I don't know. Either you guys are bored with the econ lesson or you're ready to get into Columbus, but either way, that's what we're doing. All right. So, basically, this is our total market. So what I promised last month is that I was going to go into a couple of specific markets within Columbus. So I intend on doing that here in the next slide. But in general, I always like to point out seasonality. And so you can see that the number of new listings market wide last year peaked in May. So that was when the highest number of new listings listed on the market. And then it kind of declined from there after a slight bump in July. We saw another slight bump, again, market wide in October. Once we dig into a couple suburban school districts, you'll see that market wide stuff is a good conversation, but it really doesn't apply to local real estate nearly as well. But the general trend I want you to know is that buyer activity, and I measure buyer activity by the number of properties in contract, peaks in June, May or June, and then basically declines pretty consistently through the end of the year, and then starts to go back up again in January, which you guys all probably know. But basically, a couple dates to keep in mind in general would be you want stuff to get sold before October, the end of October. And then your competition is least typically sometime in March with the highest amount of buyers. And then April is usually a spike in listings, with May being the highest month. And then the new listings start to drop off. Buyer activity slowly drops off. So I would say that you want to get listings on the market by the second or third week of June, if at all possible, in most markets. You will see a decline in buyer activity most of the time in the month of July, and then some sort of spike in buyer activity in the August or September timeframe, and then a big drop off once you get into the end of October, beginning of November. A lot of that typically is weather dependent. So if we have a really warm October, you might see a little bit longer buyer active or an active buyer season. But if it gets cold quickly, if it's snowing on Halloween, it might be the end. As a general rule of thumb, obviously there are exceptions. All right, so here is Dublin. So as you can see, it's definitely not the same as the overall market. It's actually way more pronounced. So again, our red line are the number of in contracts. In my opinion, a very good indication of buyer activity. But the blue line is the one that we really want to pay attention to, especially if we have listings. So you can see that our buyer activity was spiking last year in March, but listing activity was all the way in March, just to put an equivalency to it, was equivalent to the listing activity in October. So if you're going to list a property, and I know we're already in April, so you guys already missed this, but if you're going to list a property, listing it when buyer activity is spiking, but competition is the same as October, that's a really good place to be as a seller. So in Dublin schools, at least last year, by the time you list in April, you've missed the boat of the best time to list. Now, that being said, you haven't missed the buyers necessarily, because if we look, there was a spike in buyer activity in April. I think the drop in buyer activity in May was largely due to the drop in new listings because inventory was so low last year. But then you see, even with a drop in new listings, we still saw another spike in buyer activity in June. Now, the month where you really don't want to list, according to last year, is August, where buyer activity is relatively low, but a bunch of people listed. And you can see this light green line are the active number of listings. You can see how all these extra new listings got put on the market and they did not get absorbed by new buyers. And so if you were sitting here in July having a listing appointment and you were like, oh yeah, based on the sale that just closed 2 weeks ago, this is how quick it's going to sell. And this is how much it's going to sell for. And then all of a sudden there's a flood of new listings, like you might be in trouble. Now, some of this, especially in Dublin schools, could be new construction. Like there's a number of reasons why this could happen, but just know that having these conversations with a seller makes explaining why only 3 people showed up a lot easier. If you don't have the conversation with the seller about what happened last year and this happens again, then you look like you don't know what you're talking about. So you're never guaranteeing based on what happened last year is going to happen again. But boy, oh boy, is it a much easier conversation to explain ahead of listing that listing your house in August might not create the same activity that your neighbor who listed in May had. And here it is right in the data. Now, the interesting thing that we'll see in Hilliard as well is that the number of new listings and buyers so far through March, now this is all pre-tariff, had been kind of trending hand in hand. So even though our actives were higher, if we look at March last year, our actives were just a little bit above the solds. This year, we have more inventory compared to the number of solds. But what this is telling us is that most of the new listings, if not all of them, are being absorbed by the market. And for those of you this is from Trend Graphics. So I think most of you have access to this data, but you can get very granular with this, which I do in my listing appointments, but obviously this is just looking at the overall market. All right, I'm going to point this out because I didn't on the last slide, but in Dublin, it was the same thing. One thing that I like here, and it kind of goes hand in hand with what's happening over here, is that our new listings are up 28% from February to March, but our number for sale is only up 5.2%, which means that the market is absorbing most of those new listings that are hitting the market. So that's good information to know. Hilliard, a similar story, but if I'm listing a house in Hilliard over the next couple of months, I'm going to be paying very, very close attention to the fact that Hilliard listings tend to be very, very concentrated in the month of June. So many people are probably waiting until their kids are done with school to list their house. So if I had a listing coming up in Hilliard, I would show this graph to my seller and I would say, what can happen in order to get us on the market in May? Now, that being said, the downside to that is that we also saw a dip in buyer activity for May, and then we saw a rise in buyer activity in June. Now, that could have been that look at the difference between active and sold. So the number of active so we were dealing with like 2 weeks of inventory. So it literally might have been fewer contracts because there just weren't any listings to buy. But this is definitely, this number here is something that I would be paying very close attention to, because unlike both the overall market and Dublin, we don't really see, I mean, this is kind of a second spike, but it's in a huge way less than what we saw last June. And so I would be talking to my seller about trying to get on the market in May if I have a listing coming in Hilliard. The other reason for that, and you see the second spike happened in September in Hilliard. So that's a little bit interesting and something to keep an eye on, because that could be an indication that their spikes happen in the post-Labor Day market for whatever reason. So you could go back and look at the last couple years and see if this has been a trend or if it just happened last year. But again, like I said, the reason I would move my listing up is because so far over the last couple months, the buyers have been absorbing all the new listings, which means there's buyers there, but we're just not adding enough new listings to meet demand. So everybody following me here? Are you sick of going through this, or is this helpful? I have one more with Olentangy. I won't spend as much time because it's basically the same thing. The interesting thing with these numbers is there was a spike in July of new listings and buyer activity slightly, which I would say is a little bit abnormal. But you can see it kind of coincides with the new listings in terms of the gap. And so I have a feeling that a lot of the excess inventory was new construction that was sitting on the market. So, but new listings have matched in contracts so far in the last couple of months as well in Olentangy. So for the most part, I would anticipate that if you list it right and it's conditioned correctly, that you'll probably sell.
Hey, Troy, what's this report called in case I wanted to pull it for Grove City?
Yeah, so basically you just go into Trend Graphics on the left-hand side, click on communities, and it gives you the opportunity to pull it as a zip code, a school district, whatever. And then you would just pull that for either Southwestern or the zip code.
Okay.
And then, or you could do city, Grove City, and then you just click show chart. And this is what would come up. The only other change at the very top, it says, active, sold, and in contract. You need to click that drop down and also select new listings. Because I think the new listing number, to be honest, is almost the most important. The new listing and the pended are the most important things on here most of the time that I focus on in terms of right now demand or
Thanks.
competition on the listing side. All right, I feel like we've kind of gone pretty deep in these numbers, so I don't think there's really much here that is of note in the overall market other than inventory's up 55%. New listings in the overall market were only up 15%, but solds were down in March by 4%, so 4% fewer paychecks for those of you that are real estate agents, so something to keep in mind. Chris Shea and I had a conversation last week about the pended number that transfers from one month to the other. I think this is high. And so I'm not really sure where they're pulling this from, but the change is relevant. But again, I take it a little bit with a grain of salt. So resale only, we don't have that many new construction listings in the market, so not a ton of change here. All right, days on market, just looking at, annual trends comparing last year at this time, our sales price to original list price was 99 and 100% in March and April. Right now we're at 98%, so we'll see what happens. I'm sorry, we were at 97 and 99. So we're still overall, and this is remember the sales price to the original list price. So that means this is after all or before all price reductions. So that's still a pretty strong market. Anything above 97%, I think, is pretty strong. Obviously, it's not back in the 2021 era where it was like 103%. But definitely better than the 95 that we had in January. And then average days on market has definitely increased. And like you guys said, I think what we see is that, sometimes you have one house right next to each other. And honestly, sometimes it's just getting lucky. If you get the buyer that's lost out on 3 properties that likes your listing, it might be one of 5 showings, and then they pay over list because they don't want to lose another one. Like, I think we're still seeing pockets of that, and I think that's normally it all boils down to motivation of the buyer, right? And sometimes they just like your house, and then no one else is out there that loves the neighborhood or the street, and it sits. You just got lucky. Months of supply is honestly still really solid. As you can see, in January, when prices were kind of taking a beating as well, we saw the months of inventory go up to over 2. But we're back down to 1.5. And I mean, obviously last spring we were lower, but I mean, to put it into perspective, I mean, a balanced market is 4 to 6 months of inventory. And being that we're on a downward trend, I don't think that's something that I'm super concerned about at this point, especially given the fact that we saw that we're absorbing most of the new listings. So now again, all of this stuff is March data. This is pre-tariff. And so if we were to continue to see a lot of uncertainty with tariffs, I think you could see this. The other thing that would impact this, I think, in a big way and quickly would be either spiking interest rates or job losses. Those would be the two things that I think, recessions don't always equal significant job losses. So if we had a recession without the job losses, I still think that we would be okay. If we have a recession with significant job losses, I think that you'll see a lot of people selling their house in order to get their equity that most people have out in order to, weary the storm. I think that's why if you're not already telling your clients that have a ton of equity to go out and get home equity loans, you could save somebody's house. Obviously, you lose yourself a sale if they lose their job, but you can't get a home equity loan when you don't have income. So there's no other way to access your equity once you lose your job. And home equity loans are free to get. And most people have tens, if not hundreds of thousands of dollars locked up in their house that would be available to them on a rainy day if they had a home equity loan. So they usually need those updated like every 10 years. So you have quite a bit of runway. Months of supply, we've already kind of went over that. New construction, I mean, it's definitely more volatile in terms of the graph because of the fact that there's such a smaller amount of homes on the MLS that are new construction. But as you can see, the amount of inventory even there has been going down. So I think overall, in general, up until the last couple weeks, we were in a quickly improving market, and it'll remain to be seen, I think, much driven by interest rates as to whether or not that trend continues in April or whether it reverses course. All right. I got a little bit like sidetracked with this graph, so that's why there's so much here. Hopefully it's helpful for you guys. If not, I had fun doing it anyways. But this is a trend that I had seen when we're talking about pricing. I've talked about it the last few months, but I had never like gone through and put it in visual form. But basically throughout the last couple years, and I think some of it was driven by Intel land coming on the market at really high prices, but our average sales price or list price was super high. So you can see like at last April, the difference between the average list price and the average sales price was $153,000. Or I'm sorry, the average for the for sale properties between the sold properties, not the average list price sales price. And now for the last several months, we've come into a pretty tight range between about 70 and 80, maybe 85. I think maybe January was 85. And so why is this important? Because like the realtor.com data, for example, was based off average listing price or average active price. And so last year that was way higher here in Columbus, but it wasn't actually shown in the sold price. So even though our active price was really high, our sold price So our active price has gone down significantly by $100,000 on average, but our sold price has gone up. So our active sold price was up 4.5% from February to March. So theoretically, and this is obviously average, but theoretically, if you own a home, the value increased by 4.5% from February to March. That's not real life. But the better indication would be March to March. And it was still over the last 12 months, theoretically, your home has gone up by 5% in value. So I just had a conversation before this meeting today. And the conversation was, with everything going on, should we wait or should we buy? And ultimately, after going through some of this stuff, I said at the end of the day, if you plan on staying in the house for 5 years, and this is something to write down if you want like one thing to take away from this, this would be my script. If you plan on staying in the house for 5 years, I believe that the Central Ohio real estate market is positioned to be equal or greater in price 5 years from now, almost 100%. I have almost 100% confidence in that. And I also think that there's a really good chance, just like the last 12 months, that a year or two from now, you're going to be looking at higher prices than you are today. And the last thing is that I believe I believe it. And there is zero experts that are predicting rates to go below 5% anytime soon. And so if somebody goes in and runs their payment at 5% or 6%, the difference in payment is there, and it can be significant depending on the loan amount. But at the end of the day, it's a much smaller difference than the payment on their current mortgage and the one that they're buying. And so what that means is they're comparing two unrealistic things. They're comparing their current mortgage on a house that was priced at 50% of what they could buy it for today. And they're also comparing it to an interest rate that we may never again see in our adult life. Honestly, it's bad if we do see it because that means the economy is really bad. And so at the end of the day, like, people need to quit. If they aren't willing to move from their 2.5% mortgage, then they shouldn't move. But if they want to move, they're going to have to get over the 2.5% mortgage. And that's essentially, and every year that they wait, most likely the cost of the home that they're buying is increasing. And most likely the interest rate isn't getting that much closer to where they're comfortable. And that would be my takeaway if I had to have one. All right. This one kind of irrelevant now because of seasonality. I'll come back to this next month. This was the updated one I wanted to show you, and I apologize for the grainy photo. If you guys want the slides, I'll get you the non-grainy one, but this was the quick copy and paste. This is an interesting one, though. For all of you that said in the last 2 weeks that things have slowed down, this is an indication. This is the total number of showings for those of you that remember like 4th grade graph plotting. On the y-axis are the number of total showings that happened in the market according to showing time. And on the x-axis, it's the week of the year. So for those of you that come on to this every month, I've been creating this, building this over the last couple years. And so we have 3 years coming on our 4th year of data of this. And the interesting thing is, although I think all of us admitted that we felt somewhat of a slowdown in buyer activity compared to 3 or 4 weeks ago, the weird thing is the total number of showings that have happened in our market on showing time have actually been in line. And it looks like we're going to trend higher than every year except for 2022, which is the first year that we have the data. Now, I told you guys about the good times to list. These, you might not be able to read these. For those of you that are new, it says Easter. This is Easter 2022 right here. The lowest point of buyer activity in 2022. This is Easter 2023, and this is Easter of last year. Do not list a home on Easter weekend. That's the number one. There's no other holiday that has that level. Even July 4th, which I thought would be pretty consistent. I guess Memorial Day is pretty consistent too, but July 4th is even kind of all over the place. Easter weekend, from the showing amount, like look at this in 2022. The week of Easter was like a crater that happened in buyer demand. Now, I say that somewhat tongue in cheek. I think that part of the reason why it's higher the week before and the week after is because you still get those showings. But I would say that buyer demand on Easter weekend is very, very low. It's the lowest weekend of the spring season for sure. But the other moral, or the other takeaway from this slide, would be that buyer demand appears to be trending slightly above, or by the number of showings, I shouldn't say buyer demand, but the number of showings that are occurring appears slightly above in totality the number of showings that have happened over the last 3 years. Not much, but you can see that the first 2 months of the year we were trending below the last 3 years. So it's pretty significant, actually almost the first 3 months. It's pretty significant that showing activity, even over the last 2 weeks, has been either at or slightly above where it was before. Last but certainly not least, rentals. For those of you that work with investors, this is a good thing. We've had a decrease in average rent over the last month, but year over year, $5 increase. In general, rents are relatively flat. You can see it here on the graph. However, they did start the year off higher. And I would say still, if you're working with investors, many investment properties are severely under market value when it comes to the rent that they're receiving. And so numbers rarely work at current rents, but I would encourage you to go through the exercise with your investor about what it would look like if we bring those up to market rents and what it's going to take from a repair perspective to do that. And I think some investments definitely start to make sense once you do that. All right, there's my sources: Mortgage News Daily, which did not come through today, but Realtor.com trend graphics. And then the rental data is in the Zillow Rental Market Manager. So thank you guys for listening to me, as my kids would say, yap for the last 50 minutes. I do have a few minutes if you guys want Q&A. If you have to go, I totally get it. I was a little long-winded today. Who has feedback, questions, concerns, comments?
Thank you. I appreciate it.
Yeah, absolutely. My pleasure. It's yeah, it's fun for me. It holds me accountable to getting all the data. So anybody else have any anecdotal experiences that you want to share? Or
I have one quick question for you,
yeah.
Troy. So when it comes for a lot of not really sellers, but buyers who are trying to understand how their equity works in their home, I'd kind of explain it in a way that year over year, when we look at percentage wise, you're always increasing just from appreciation alone. But I try to also give them the understanding of how inflation works with benefiting them, because a lot of people feel, as you've shown the numbers, that with that inflation increase plus those tariffs, it kind of worries down buyers to get cold feet or whatever other things. How could I explain to a buyer, especially if they get into the market now, and they see that inflation, because it's not hyperinflation, it's steady inflation throughout the course of the year. How can I explain that to a buyer, how it benefits them for them when they own the home and they're continuously gaining that equity throughout the years?
Yeah, I think that's a great question. And I think, again, like I said at the beginning, I go through a lot of stuff here, and I would, if you're a nerd like me and you enjoy it, it's fine. But I would also just in general caution you, not just you, and if you like, it sounds like maybe you like it too, and if you understand it at a high level, but I would try to keep things pretty, um, like surface level when it comes to these conversations, just because these can be very, very deep concepts that, and sometimes you get people like off in the weeds, and it kind of takes away from what you should be said. And so I say all of that to say that the easiest way to handle that is that, what's the alternative? So Jay, let's just role play real quick. So let's go through these people's general situation. Are they renting currently?
Yes, for the most part.
Okay. So the easiest way to handle that, and I don't feel like I explained it as good as I could have, is basically, okay, so Jay, what you're telling me is that you're worried because everything's going to cost more. And so it's not going to mean that my home has technically appreciated because compared to like what I'm making, for example. Well,
Right.
the short response to that is, how much appreciation on your rental property are you getting?
0.
0. And actually, what happens to your rent when everything is going up?
It increases, as would your mortgage would be
Exactly.
stuck at that rate.
Absolutely. So your mortgage is, your principal and interest portion at least is fixed for the next 30 years. So the cool thing is that, outside of taxes and insurance, which, sometimes go up, but typically not as much as rent payments go up. I mean, I know on my rental properties, like $50 a month per year is a minimum increase. And the higher the amount is, the more I'm going to do that. So I think that's what I would focus on, is say, like, you're right, and when inflation happens, everything goes up in price. But if the alternative is renting, wouldn't you rather be experiencing that appreciation and that money that goes into your pocket versus just paying more in rent and getting nothing more for it?
Right. I like that. I like that. Appreciate that,
And then
Troy.
and then the last thing, the last thing on that would be that, unless you think that prices are going to go down, every year that you don't buy, the home that you're buying gets more expensive. If you buy it today and lock in today's price and interest rates go down in 3 months, you can always refi. But you can't ever go back to today's pricing after today.
Right. Date the rate, marry your home.
Yeah, just be careful with that. Just make sure they do 30-year fixed if you're going to say that. Because a lot of people said that with the 2-1 buy downs, and now their clients' interest rates 3% higher, and they are more married to the rate.
Oh
So,
man.
what else? Anybody else have anything? No? All right. Anybody? Cool. Well, you guys have an amazing rest of your week and a great rest of April. And I will see you all next month. I would love it if you come back. The one thing I didn't mention is, feel free to email me at troy@marshhomegroup.com, and I'd be happy to have Allison send you over the slide deck. You're more than welcome to R&D whatever you want. You can post it on social media. You can do whatever, you need to do, or what you consider valuable. Like I said, I do this and I'm happy to share. So, thank you guys again for coming and supporting, and have a great rest of your day.